Thank you all for joining us today. Super excited to be presenting on a topic here that is near and dear to my heart and something that is a very, very important decision and determination when building a financial plan and making some very important decisions as a business owner. So are you paying yourself the wrong way? A lot of times we look at our situations and look back at how many mistakes we've made, what have we done to optimize our financial future? Are we reaching our goals? Are we getting to where we ultimately want to get to? And why are we working so hard to build the wealth that we've been building for all these years, to give too much of it away or not to be optimized in accomplishing the things we ultimately want to accomplish? So what we're going to go through today, we're going to go through the top 3 mistakes with paying yourself. So the top 3 challenges that we see when people are paying themselves as business owners and successful entrepreneurs. We're going to go through the difference between salary versus dividends, one of the most common questions we get, and one of the most important decisions that you have to make in how you pay yourself as a business owner. We're going to go through the Canada Pension Plan and RRSPs and whether they're the best retirement options for business owners. And I know business owners here a few times already because financial planning for business owners is very, very different than financial planning for individuals. Financial planning for business owners results in much more different strategies, different structure, and different focus than your traditional individual employee. And then we're going to talk about a real life case study that we're going to go through that we've worked with one of our clients. And then we're going to leave some time for questions and answers. And I encourage you all to put the questions into the chat box as we go through them. I will go through them at the end of the presentation. Presentation will be about 35 minutes. And then we'll have about 20 minutes left over for questions. So please make sure you put those questions in. We always get a lot of really, really valuable questions. And we love getting them. We love going through them. And just making sure you're in the right room here. This presentation is for growth-minded business owners looking to optimize how to pay themselves. So really we're looking at how to build a successful financial future and making sure you're making the right decisions and how you're paying yourself as a successful business owner. This is not focused on employees or individuals. It's specific for business owners. And financial planning for business owners, again, it's very, very different. There's a lot of different questions and there's a lot of different criteria that come up when strategically building a financial plan for an entrepreneur and for a business owner. So a little background on myself. My name is Jay Gangnes. I'm the founder of Ocean 6 Wealth Advisory. I am a certified financial planner. I'm a chartered life underwriter, and I'm an entrepreneurial advisor, which is very, very different than your traditional employee advisor. We focus specifically on business owners and all of the challenges and different things that arise as an entrepreneur and as a business owner. And much of the business and much of the focus that we have in our process falls around a lot of the challenges that I had as I grew my business and as I learned as an entrepreneur, because it's not stuff that's taught in school. And there's a huge, huge gap there between what we learn in school for our trade, even as a certified financial planner, and what is actually required and what is needed to build a successful business and how to structure it efficiently, how to pay ourselves, how to plan for our retirement, how to reach financial freedom. Why are we working so hard? What are we ultimately trying to accomplish here? And there's a huge, huge gap there that we focus a lot of time on that's different than a traditional financial plan, because it's really not about the money. It's really about what are we building all of this wealth and all this success, and what are we trying to accomplish with that money? We really don't necessarily want more money. We want what that money is going to do for us. So a lot of these decisions are really, really important in how we develop and how we grow as business owners. I've also got 21 years of experience in helping business owners achieve their dream life. So major focus for us is how to accomplish all of the goals and dreams that you set out when you became an entrepreneur and when you built that business in the first place. All right, let's dive into the mistakes, which we're hoping everybody is avoiding and will avoid after we get through all of the breakdown here today. So 3 mistakes with paying yourself. Number 1 is no plan or strategy. This is very, 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 very important. So when you decide on how much money you're going to pay yourself or how you're going to pay yourself, you need to make sure that you establish a plan around that first. A lot of times people can be reactive. They're taking money out of the court. They're using that money for their day-to-day lives, but there's no alignment with the big picture goal and ultimately what they're trying to accomplish. Number two is paying yourself the wrong way. So we talked a little bit about salary versus dividends. What is the optimal way to pay yourself to accomplish your goals, to keep that money in your pocket, to really strategically plan to build that bigger future? Really, really important to align with making sure you're paying yourself the right way. And finally, paying yourself too much. And this is something almost universally we see with everybody that we sit down with. And it is very much a reactive approach. So if you're paying yourself too much, then you're likely paying too much tax and you don't have clarity around what is the goal, what am I trying to accomplish, why am I taking this money out of my corporation? So when you're paying yourself too much, you're ending up making multiple mistakes from a cash flow standpoint, and you're making multiple mistakes from a clarity and alignment around what you're ultimately trying to accomplish. So a little bit of the consequences that come up with paying yourself too much. Again, you end up paying too much tax. So really, really important. When you write a check to CRA, when you take money out of your corporation and you write that check to CRA, you are never going to get that money back. It's really, really important. Whereas if you pay yourself in the right way and you pay yourself the right amount of money, you're not going to write that check to CRA. You can leave that in your corporation. You can pay a much lower tax rate and you can keep more money in your pocket to invest, to grow your business, invest in yourself, and you really have more control over that money. So you want to make sure that you're paying yourself the right way so you're not paying too much tax. Number two, using your corporation as a personal bank account. This is something we see almost all the time as well. So what ends up happening is you take money out of your corporation and then a big purchase comes up, or a vacation. You take an additional chunk of money out of your corporation and then you end up building up an additional amount of income in that year. And then tax time comes around and you have to pay that tax bill. Then what do? You take another chunk of money out of your corporation. Very common mistake that we see in business owners using their corporation as a personal bank account and just pulling money out as needed. And the biggest challenge that we see with that is there's no alignment with exactly what those big picture goals are. And I mean, with business owners that we work with, we see all the time, you're working hard, you're building your wealth, you're grinding out your business day to day, but you oftentimes feel like you should be further ahead. And the reason for that is because you're pulling that money out and it's not directly correlating to exactly what you're trying to accomplish when you set out building this business in the first place. Next one, there's no alignment with your goals and your cash flow plan. So this one is very, very, very important as well. Making sure we know exactly what the goals are, making sure we know exactly what you're trying to accomplish with your business, and building a structured cash flow plan. Now, one thing I will note, a cash flow plan is not a budget. A cash flow plan is very, very different from a budget. A cash flow plan is a structure that allows you to have clarity and confidence around knowing exactly where your money's going, so it's going in the right place. And most of the time what we will see is we see people allocating money towards all the things day to day, and whatever's left over goes towards those big goals and those big rocks and those big important things. With a cash flow plan, we want to have that foundation, which isn't strict. It's just clear around where that money's going, and so we know exactly that it's going to those most important things in your life. Quick story: we had one client. He was actually an employee, but his spouse owned a business. Business made about $1 million a year. He was an engineer. He made about $450,000 a year. And we gave him a cash flow structure that aligned to about $250,000 a year. So he came back to us and said, there's no way I can operate off $250,000 a year. I want to enjoy my money. I want to have freedom. I want to have flexibility. And we said, that's absolutely no problem. Let's look back at where the money went over the past year, and then we can review and decide on how much you want to have moving forward. We want to make sure there's a comfort level. So next meeting, he came back and he said, okay, well, last year I bought a Porsche, I bought a $40,000 watch, and I bought a $25,000 couch. So we said, okay, great. Nothing wrong with buying those items if they're important to you, but are you planning to do that every year? So we settled on around $300,000 in income. And he obviously didn't need to buy those items every single year. And we were able to allocate a significant amount of money every year towards some of the bigger picture goals. This client has now been with us for over 6 years. He's bought 2 investment properties with 3 other partners, one in Palm Springs, one in Mexico over COVID. And he spends a significant amount of time there, which was always one of his major goals and dreams. But before going through a very clear and structured cash flow plan, he was allocating money towards just things reactively with what he thought he wanted in those moments, like Porsche couch and a watch. Now, I will note those things are not, there's nothing wrong with buying those things, but are those the important things in your life? And are those the goals that you've set out to accomplish? So we want to get clear on that when we build the cash flow plan so we know how much money to pull out of the corporation. Next one, there's less liquidity. So of course, if you're paying too much tax, you're going to have less liquidity. If you're paying yourself a salary and you're paying into the Canada Pension Plan, there's going to be less liquidity. If you're building up RSPs and putting money in RSPs, there's less liquidity. So nothing necessarily right or wrong with those. But if you want to look at having access to capital, then you can have some consequences there with less liquidity. And we talked about this overspending on unimportant things. And that doesn't mean we don't buy, cars and watches and couches. Those things are great, beautiful items. But if they're not important to you, you don't want to look back 5-10 years from now and say, I did really well. I made a lot of money. I had a lot of success. But I just feel like I should be further ahead because I didn't allocate the money towards the things I'm most passionate about. And a lot of times you want to look at experiences for those things as well. Okay. So just a quick little story here. This is an allocation of time, and it was presented by a professor many years ago. So he brought a jar into a classroom, and he took 3 pebbles, and 3 big rocks, and he put those rocks into a jar. He turned to the classroom and he said, "Is this jar full?" Classroom says, "Yes, that jar's full." Then he took a handful of pebbles, filled the jar with the pebbles, turned to the class. He says, "Is this jar full?" Class chuckled. They said, "Oh yeah, okay, now it's full." Then he took sand and he poured sand into the cracks of the jar, turned to the class, said, "Is this jar full?" Class says, "Okay, yes, now it's definitely full." Then he took some water and he poured the water into the jar, said, "Now is this full?" So the analogy here is that if you put the water, the sand, and the pebbles into the jar first, there's no room for those big rocks. So if you're allocating your time towards those unimportant things, there's no room in your day-to-day and there's no room in your life for some of those big important items. So we like to utilize that analogy for money. And if you have clarity on exactly what those 3 big rocks, 5 big rocks, your North Star, those really important things in your life that you're trying to accomplish, then it's very, very easy to allocate a cash flow plan and look back 5 years from now and think, hey, I did really well. I don't feel like my money has been wasted, and I really feel like I'm getting ahead. So if we can structure your cash flow plan effectively, we know exactly what those big rocks are, and we're not spending money on the sand and the water and the pebbles. That's secondary. We want to put first things first. We want to put the important before the urgent, and we want to make sure that we're accomplishing those big goals. After all, that's why we're working so hard. So to summarize here, before anything else, before we make a decision on exactly how to pay ourselves, before we make a decision on exactly how much money to pay ourselves, we must have very clear goals. And there is no ability to build a properly structured financial plan without knowing exactly where you're going and without allocating the money to the important things in your life. And if you do that properly, then the decision on how to pay yourself is quite simple. Step 2, you want to build yourself a cash flow plan. Now, a cash flow plan, again, it is not a budget. It's a structured foundational piece that allows you to have clarity that your money is going to the most important things in your life first, and then you can spend the rest of the money. And it's a very behavioral component to your cash flow. We don't want you spending, and saving what's left over, because the money's not going to be going to the right areas, and the amount left over isn't going to be aligned with your bigger picture goals. So you always, always, always have to have clear goals and a cash flow plan before you decide how you're going to pay yourself. So with that being said, let's dive into how to pay yourself. So there's two options, salary versus dividends. Very, very common and significant debate. I've had it many times with many different accountants, many different individuals that have different opinions on exactly what this is. And I will note before we dive into here, there is no definitive, terribly wrong answer here, but there is one that we highly encourage people to focus on, and there is definitely one that we recommend and that we will go through today. So first things first, salary versus dividends. Salary is going to generate RSP room. Dividends will not generate RSP room. So if you want to build your retirement by putting money into RSPs, you want to be paying yourself salary. If you're not worried about RSPs, then dividends is totally fine. Next thing, with salary, you're going to pay into the Canada Pension Plan. And the Canada Pension Plan is a government-run social insurance program that is paid for by your employer and by you. So if you were an employee, there's $8,000 that goes into the Canada Pension Plan every year. $4,000 is paid by your employer. $4,000 is paid by you. If you're the employer and you're the employee, which if you're an entrepreneur, if you're a business owner, then you are in fact both, then you're paying $8,000 into the Canada Pension Plan. If you're paying yourself dividends, you do not need to pay into the Canada Pension Plan, and you can keep that money in your pocket. Very, very important differentiation. Next piece, personal tax. So with salary, you're going to pay higher personal tax, lower corporate tax. With dividends, you're going to be paying lower personal tax and higher corporate tax. Now, in the Tax Act in Canada, there is a proposed integration of these two things. So whether you're paying yourself a salary or paying yourself dividends, then that integration should net the exact same number. Integration is very close, but it is not perfect. So oftentimes with salary, you will have a slightly higher amount of money, and this has not always been the case. A lot of times in the salary versus dividends debate, people think dividends, you end up with more money. You actually do not. You end up with more money with salary. It's a very small amount, and it differs with each province and each amount of money that you're pulling out, but it is in fact slightly higher with salary. So let's dive into these numbers a little bit so you can unpack it. So how salary is treated with paying into the Canada Pension Plan. And I will note, you always have to pay into the Canada Pension Plan with salary. So it's not an optional piece. If you're paying yourself salary, you do also pay into the Canada Pension Plan. So let's use the example of $100,000. So you have $100,000 salary. You're going to also pay $4,034 into the Canada Pension Plan from your corp. So the total cost for the business is $104,034. So this is a really important piece. And that is something, if you're the owner of the business, obviously you are then making that $4,000 contribution. You're also going to be making the $4,034 personal CPP contribution. So a total of $8,068. So $4,000 corporate, $4,000 personal, and then finally you're going to have $19,648 of personal tax. There's no corporate tax when you pay yourself a salary. So your take home here would be $76,318. This is in British Columbia. Very important to note. Very similar throughout Canada, but it will differ a little bit province by province. So in British Columbia, $100,000 salary, you're going to end up with $76,318. So dividends. Dividends, you will not pay into the Canada Pension Plan. So very different. And again, employee contribution and employer contribution. There's two pieces there. You don't pay either one of them. So what this means, if you remember, salary had $104,000 cost. This also would have $104,000. You want to compare apples to apples. So $104,000, that means $4,000 is left in your corporation. It's extra cash that you control and you get to decide what to do with it. You would also then have zero personal CPP contributions. So you're going to pay $4,000 in the corp, or you're going to have $4,000 left in the corp, sorry, and you're going to have zero personal CPP contributions. You're going to pay $11,000 in corporate tax because this is not deductible, so you have to pay corporate tax on that. And then you would have a much lower personal tax rate of $10,469, for a total net amount of $78,535. Again, this is in British Columbia. So the results of the CPP versus no CPP, or salary versus dividends, depending on how you want to look at it here. With salary, you're going to take home $76,318, and you're going to pay $8,068 into the Canada Pension Plan. If you're paying yourself dividends with no Canada Pension Plan, you're going to take home $78,535. That's a difference of $22,17 personally. So you're going to end up with $2,217 personally, $78,535 instead of $76,318. And then you're going to have an extra $4,000 left over in the corp that you did not put into CPP. So, very simple question you want to ask yourself. Would you rather pay $8,000 a year into the Canada Pension Plan and only have access to that money at age 65, which is fully taxable? Or would you rather have about $6,500 in your pocket to control and invest today with access to in your life? Now, again, we always want to look at, are you focused on flexibility? Are you focused on access to capital, liquidity, innovative financial opportunities, and different ways to control that money? And we always find with business owners, you are always going to be better off to pay yourself a dividend and take full control over your entire financial future and take full control over how that money is invested. So paying yourself a dividend as a business owner is always what we're going to recommend. So first and foremost, you do not have to pay into the Canada Pension Plan, and you control those funds. So one of the biggest reasons for this is that if you pay into the Canada Pension Plan for 20, 30, 40 years and you die prematurely, you do not get any money. So you could pay into the Canada Pension Plan, pay hundreds of thousands of dollars, and end up with nothing. There are very small spousal benefits if your spouse is still alive. Now, I will note that is definitely only a 50% piece, because if you have a spouse, one of you is going to die first. So 50% chance your spouse will get a small amount, and it's a very small amount, a couple $100s a month. There's also a child benefit, which is also a very small amount, a couple $100s a month, if your kids are under the age of 18 or under 25 if they're going to school, which is a rare occurrence. So for me, that criteria results immediately in choosing dividends and having full control over that $6,500 instead of potentially losing all of it to the Canada Pension Plan, because there's no money left over if you pass away prematurely, and there's very little money if you pass away shortly after age 65. Second one here, greater flexibility with how you pay yourself. So you can take that money, you can adjust how much is going into your personal account, you can adjust how much is staying in the corp, you can adjust what those investment opportunities are, such as investing in your business, investing in yourself, investing in the stock market, investing in real estate. When you put that money into the Canada Pension Plan, you don't have access to any of those tools. You only get what that number is 10, 20, 30, 40 years down the road. The government has available to contribute across the Canada Pension Plan universally. Access to cash in the event of personal financial difficulties. This one's also important. You know, if you built up a couple $100,000 over 20, 30 years and you need that money, it's there. Canada Pension Plan is not liquid. You do not touch it till 65. I will note you can take it at age 60, but generally it's taken and started at age 65. And if you want to have that liquidity and that access to capital, very, very important to maintain that liquidity and have access to that $6,500 over the years. And finally, you can customize those investment opportunities. I'm an avid believer that the best investment you can make is in yourself, and the second best investment you can make is in your business. And if you're investing in the stock market or real estate, you're investing in other people's businesses, or you're investing in things you have less control over. Not that they're bad investments, but we recommend you utilize that cash and how to optimize and grow something that you're an expert at and something that you do very well, as opposed to giving that money to the government or putting it into other vehicles. So having access to that money to control how you're generating your future wealth is extremely important. So one of the biggest questions we always get, but a salary generates RSP room. Isn't that good for retirement? The answer is maybe. And the reason why that answer is maybe is because if you are a employee, which you are not, but if you are an employee and you earn $200,000 a year, RSPs can be a valuable tool. If you're a business owner, then you want access to that capital. If you're putting money in RSPs, you're basically immediately splitting that money with the government and losing liquidity. Because if you put money into an RSP, you get a tax deduction, so it goes in tax-free. But then if you want to access it at any time, you have to pay the tax. So the government owns 30, 40, 50% of that money via a tax bill. Now, the other thing with RSPs is that if you are contributing to those RSPs today at a high tax bracket, and you're a successful, driven, motivated, growing business owner, it's very unlikely that you're going to be at a low tax bracket 20, 30, 40 years from now. So the idea of an RSP is that you put it in at a high tax bracket and you pull it out at a low tax bracket, but it's very unlikely that you're going to be at a lower tax bracket. And with the way the government has been spending money and the deficit that we're in, it's very unlikely that tax brackets are going to have any significant decrease over the next 10, 20, 30 years and generate less taxes owing when you pull that money out. So just to summarize, RSPs for business owners, we generally don't recommend. If you do have a little bit of money in RSPs, I do from many, many years ago when I did pay myself a salary. I have not paid myself a salary for over 9 years. But if you do have a little bit of RSP room, that's not going to be a problem. If you have too much, you're going to end up in a big, big tax problem. So just to summarize here, wealthy business owners are not guaranteed to be in a lower tax bracket. Money is fully taxable upon withdrawing that money in an RSP, and you have also limited investment options. So in an RSP, you're actually going to be invested in the stock market, you're going to be invested in bonds, you can't buy real estate, you can't invest in your business. You pull that money out, you're going to pay tax. So we don't love RSPs for business owners because it eliminates a lot of the flexibility and it eliminates a lot of the access to that capital to grow in other ways that you can control. Okay, let's dive into a case study here. So this is Sarah. This is one of our clients we worked with over the past couple of years. She was paying herself a salary of $180,000 a year. And very interesting dynamic here because Sarah actually had a mortgage with that she was planning to pay off. That mortgage had an interest rate of 1.8%, and she was paying this mortgage off every single year, and that's why she was taking out $180,000. But that mortgage was almost paid off when we met with her. And we said, well, her goal was to pay off that mortgage, but she would have been much better off to leave that money in her corp. To pay off a 2% interest rate, you have to pay 50% tax. So it didn't make sense. So she was taking money, more money than she needed out of her company to live, leading to much higher taxes and aggressively paying down her mortgage as fast as possible. Very common thing that we see. People want to pay down debt. Debt is bad. Debt is a problem. Debt is a negative. Now, we don't disagree in some aspects, but we think tax is a much bigger problem. So if you're taking $10 out of your corp to pay down $5 of debt, you'd be much better off investing that $10 in your business than paying off $5 of debt, especially when that debt is at 2%. She paid herself a salary to build up RSP room, so she was putting money in RSPs, which was money that she didn't plan to touch for 20, 30, 40 years until she was retired. And she had no clear goals or cash flow plan or path to financial freedom. So she was just basically taking this 180 grand out, doing what traditionally is done in Canada. Put a little bit of money in RSPs and pay down her mortgage. Very common approach, very common, especially with employees. But she's a business owner. You have to think a little bit differently, and she's an entrepreneur. So innovative and outside of the box thinking was required to make sure that she had a clear path to retirement and kept more money in her pocket. So her new setup, she took a much smaller dividend because we didn't want to pay down that mortgage. Was almost paid off, but she didn't want to pay down the rest of that mortgage or need to at such a low interest rate. We also wanted to keep her in a lower tax bracket to not be paying 50% into 50% tax to CRA. And we left more money in her corporation to invest, which allowed her to have access to that money for her business, allowed her to invest in other vehicles. She has multiple different vehicles now, different investment strategies. And we used her corporation to plan her retirement, not RSPs and CPP to plan her retirement, which allowed in much more flexibility, much more freedom, and much more confidence that she was actually going to get to that state with a clear plan and knowing that she was in the best spot to optimize her financial future. She had more control and she was able to use that cash more freely. So having access to the cash for her was significantly valuable. When it was paying down mortgage and paying into RSPs, she didn't have access to that capital. And at the end of it, she was confident. She had a clear path to financial freedom. She knew exactly where her money was going, and she knew exactly what those important things in her life were that she was going to accomplish. Okay, so quick little takeaway here. Make sure you're clear about your goals and cash flow plan so you know how much to pay yourself. This is of the utmost importance. Go through a clear goal setting exercise. We have one on our website. We'd be happy to send it out to you. Make sure you have a clear structured cash flow plan. That is step one when we go through our financial planning process. Goals, cash flow. Once we get that foundation built, then we can start building that bigger picture plan and get a clear path to financial freedom and know that you're going to accomplish what you set out to accomplish when you started your business in the first place. When you pay yourself dividends, you have more control over your money and your retirement plan because you have more cash in your pocket and it's not controlled by the government, and you're not putting money into RSPs, which allows you to control exactly what those investment strategies are as well. Real estate, your business, other vehicles. And there are much better ways to plan for your retirement than using the Canada Pension Plan and RSP as a business owner. And again, very different if you're an individual, very different if you have a high income and a high salary. We would actually recommend RSPs as a very good vehicle in that dynamic because you want those tax deductions in the early years. And as an employee, it's one of the only tools that is available. As a business owner, there's many, many more that are available. So you don't really have to make all the decisions on this. You can leave the heavy lifting to us. Little background on what we do and who we are. We are a fee-based financial planning firm, one of the very few in Canada. We focus on innovative advice, strategy, structure, providing significant amount of value for our clients. And we are value-centric, which means we will not take you on as a client unless before you write us a check, we know we're going to be able to provide more value than cost for that check. We have a team-based approach, so we have multifaceted advisors that offer solutions with cash flow, debt, insurance, investment, retirement planning, integrating your corporation and your corporate structure, your holdco, your opco, your family trust. We dive into the entire holistic approach to everything you're doing, so not just each area of the financial world, but each area of your connection towards money and your relationship with money and what ultimately you are trying to accomplish with building a properly structured financial plan with all of the hard work that you're doing in your business. It's also done for you. So with done for you, you don't have to do any work. We are going to take care of every aspect of it. You don't have to worry if you're making the right decisions. You don't have to worry about what am I missing because you don't know what you don't know. We are going to be those eyes to make sure that you don't have to think about it, you don't have to worry about it, and you have a clear path to financial freedom and you can accomplish all the goals that you're set out to do. And it's a lifelong partnership. So in a lifelong partnership, we're going to continuously be by your side as you're accomplishing all those goals. We have 40 years of experience amongst our advisor team, millions of dollars in tax savings achieved for our clients, and 100% client satisfaction rate. And again, the reason why we have that 100% client satisfaction rate is because we will not take you on as a client unless we know you're going to have 100% client satisfaction and you're going to get significantly more value out of the investment that you make with having a financial planner by your side and on your team. So how the process works, we would go through a multiple different meeting process that we align, strategize. We would then implement with you. So we hold your hand and implement. You do not have to do any of that stuff. We will continuously coach you along the way and update every single quarter. We are obviously available in between those quarters. You have full access to your full advisor team at all times when working with us, but you don't have to worry about doing that heavy lifting. We also have a integrated client hub, which is a one-stop shop for all of your financial needs. So this is where your entire financial world would live. You have clarity on all of the tools and proprietary tools and information that you would need. You have access to your advisor. You would have clarity on your investment accounts, your insurance strategies, your integration of your corporate structure. So everything lives in one unified spot. You don't have to go to different places to try and figure things out and have multiple accounts. You can consolidate and have everything in one unified, simple place. So if you want to work with us, we'd love to chat with you. Please go ahead and book a call. Take action, beat CRA, make sure that you're paying the least amount of tax, make sure that you're making the right decisions with your cash flow, and we will go through to ensure that we can provide significantly more value than cost in your financial picture and help you accomplish all of your financial goals and dreams. Thank you all for listening. We're right around on time here. We've got about 20 minutes for questions. I see a couple popping up. Please post your questions. I'm going to go through them in detail now. And hopefully you enjoyed and hopefully you got a lot of value and have some clear decisions on your path to how to optimize paying yourself. Thank you all again for joining. Okay. Hi, Jay. I would love to share this with my wife. Yes, we will send a recording out for everybody that attended, and you can share this and watch at a different time. Oh, I see Winnie's already answered that. Thanks, Winnie. Can you help with businesses set up to work with business setup in the USA and in Canada? I cannot help with businesses in the US in terms of setup, but we have tons of clients that have property and that have businesses in the US as well as Canada. And we have partnerships with cross-border accountants and cross-border specialists that do operate with US corporations. But it really would depend on your situation. So it would depend on, where do you live, where do you reside, where do you pay your tax bill? So do you have ties with each of these situations? So it would be worth a chat, but we would not be able to set up your businesses in the US or help with setting those up in the US, but we could probably find you somebody that would be valuable to guide you in the right direction. Christy, if you have multiple business owners in your company, do you all have to agree on the dividend salary amounts? It's a good question. Yes, you do. I mean, if you have business owners, then I think what you're asking is, do all of the dividend amounts have to be the same? So let's say, for example, you had 4 business owners and you paid a dividend of $1 million. Does that mean everybody gets $250,000? Not necessarily. You can sprinkle dividends, so you can set up with different class of dividends to allow for each individual to get a different amount based on their contribution to the business. So you do not have to set that up in stone that everybody gets an equal dividend. Christy, if that's not the question, then please feel free to shoot another one. But yes, you can play with it and have different classes of shares. But this would be required when you set up your corp or an adjustment to your corp to allocate different classes of dividends or share structure to allow to sprinkle different amounts of dividends. I see. I mean, does each owner have to agree to get dividends, or can some have salary? Yes, some can have salary and some can have dividends, but you'd want to run through, what are the goals? What is the structure? What are we trying to accomplish? What does each contribute to the business? Does one have a salary plus we pay dividends, or is there a different component of how much they're contributing to the business? And, one of the important things with that decision is deciding on the total amount to pay in a dividend. So if you remember the example, if you're paying $100,000 salary, then the business is actually contributing $4,000 to CPP. If you're paying a dividend, then are you paying that additional $4,000 to the individual? And you'd want to set up holdcos to allow to flow some of this cash into the holdco, so the individual owners of the company have control over what they do with that money after it's pulled out. Because if you're paying that out personally, or you're paying it into another holdco, so something we could definitely dive into and something that is worth a consideration and a review. All right, Matthew, is it a good idea to use company funds to buy a permanent life insurance, whole life or universal? Matt, it is definitely a strategy that can be valuable. It's something we've done for our clients in the past and something that is definitely worth considering. But it all goes back to your goals. Sometimes if you have a life insurance need, you also have excess capital, you also looking for tax exempt growth, you have a bit of a tax problem, then it can be a really, really valuable tool. But we do see sometimes when money's put into life insurance and then they want it the next year and then it's not necessarily liquid. So you have to make sure that you're doing that for the right reasons, and you have to make sure that you have a bigger picture plan that life insurance consideration integrates with it at a higher level. Bob, what if someone has foreign income from a country that has a tax treaty with Canada to avoid double taxation and 15% tax has already been paid there? Sorry, Bob, I'm not sure what the question is. So what if, are you asking if you can pay dividends with that, or um, yeah, maybe if you can clarify that question. So what if someone has foreign income from a country that has a tax treaty with Canada to avoid double taxation and 15% tax has already been paid there? Matthew, what is the best way to use money, the corporate account, to buy a new car, which may also be used for personal use? Um, to buy a new car, which may also be used for personal use. I would buy the car in the company, and then I would uh, you will have to bill the company for personal use. So if you buy a car, the car is $1,000 a month. Let's say you lease it and you use that car 50% personal and 50% business, then you would have to allocate that other $500 personally for your tax purposes. So that would be a taxable benefit personally for the car. You cannot buy a car through the corporation and use it personally without allocating that as a personal use expense. Elena, you mentioned that corporations can invest in properties outside of Canada. Will it be taxed differently on asset disposition? Yes, it would. So, in fact, it depends on which country that you're purchasing the property in, but oftentimes you're better off buying foreign property personally. But it really depends on the situation. That requires a deeper dive on the tax situation in that particular country and what the use is for that property. Is it an investment property? Is it a vacation property? Are you going to live there part-time? So there's a few different considerations there. But to answer your question, yes, a corporation can invest in properties outside of Canada, but whether that's the optimal solution and the best way to do it would definitely depend on the country and the plan for the property. Using company money, Matthew, using company money to invest will incur a 51% tax if it's passive income. How can we then use the company money to grow while we sleep? Matt's a good question. Yes, absolutely. That's no different than if that money is invested personally. But it also incurs what's called a capital dividend account credit. So, and it also is tax deferred if it's invested in capital gains vehicles. So there's quite a lot there. If you invest in corporate class funds, then that 51% is taxable, but half of it is a capital dividend account credit. I don't want to get too technical with this question, but you're going to be taxed on the growth of this money in an RSP, the growth of this money if it's personal outside of a TFSA or in the corporation. But if you're investing in the corporation and you're paying that 51% tax on passive income, you're starting at a much higher number than you do if you pull that money out in a non-registered personal account. So it ends up being a much larger number down the road. Robin, is there a case for paying yourself a higher amount if you are hoping to buy a house in the next few years and want the bank to see a high salary? This is very much a mortgage related question in terms of approval on your mortgage. It really depends. I would recommend that you work with a mortgage broker that understands how an entrepreneur pays him or herself and how you can utilize some of that corporate income that you're not taking out. So if you're paying yourself a dividend, it does actually qualify as income for a mortgage. I would also possibly, in your situation, I would possibly consider maybe buying the property in the corp. Sometimes it makes a lot of sense to do that and can result in a much easier access to the property, and then you rent that property to yourself. So that's something we've done with many clients actually, where they've got $1 million in their corp. They don't want to pull that $1 million out and end up with only 600 grand to then go buy a property. So we just buy the property in the corp, and then we rent that property to that individual on a personal basis. So very, very valuable strategy and way to do it. But that one requires a bit of a deeper dive, and you definitely get some value over going through a process and aligning with the goals and how to accomplish some of that stuff, Robin. How can you use company funds to plan for retirement? So many different ways. You can invest in real estate, you can invest in the stock market, you can use life insurance like somebody asked earlier. You can invest in your business, sell funds to your business and grow that money in any type of investment account. You can sell your business if you've built up a valuable business asset. Anything that you leave in your corporation, any money that's in retained earnings, you can use that money to plan for your retirement. And you can use any investment vehicle. So your corporation would act as a separate entity. Very valuable sleeve and very valuable tool to allow you to start at a much lower rate and build all of your retirement plans in there. There's also very innovative ways that allow you to get money out of the corp tax-free. You can borrow money against the corporation tax-free. There's quite a few different ways to do it. Definitely something we would cover in going through the optimal way based on your goals and how you want to structure things. I will also add to that that you would want to set up a holding company, maybe a family trust as well. So those are also important considerations when doing this. Thank you, S. Bradshaw. Looking forward to talking to you. Matt, again, taking money as dividend is not tax deductible expense and salary is tax deductible expense. Taking 100K as dividend will mean my company will pay tax for 100K. Your company would pay 11% tax in British Columbia on $100,000. So you would then be dividending $89,000 out on $89,000. So if we look back at the example we went through, that's the net. So 11,000 corporate on a dividend because you pay corporate tax, and then your personal tax rate would be much lower. So you end up having a close integration with your corporate tax and your personal tax. How can a business owner use a participating whole life policy to aid with retirement? So Matt, similar to the last question, you would be putting money into a life insurance policy. The cash value would grow tax exempt, and then you can use that cash value to help retire. Now, again, can be a very valuable tool, something we do recommend in certain situations, and definitely something that we can talk to you about. But it depends on your goals, depends on the optimal structure, depends on where your cash flow is sitting and what you're utilizing from a bigger picture standpoint. But it can be utilized because there's a cash value in there, and that cash value can be accessed to help with your retirement. Bob, thank you so much. Thanks for joining us. Victoria Jankowski. Hi, Jay. You mentioned that there are many options to invest the income staying within your business. What are some of those options? How would the corporation be taxed on those? And then what's the best way to take them out of the corporation in the future? Dividends? Thanks for awesome presentation. So Victoria, yeah, one of the main things we recommend is corporate class mutual funds and corporate class ETFs. So with corporate class, it allows you to have all of your income as capital gains. And so if you have a $100,000 capital gain, so you've invested in a fund, you have a $100,000 capital gain, that would mean you have a $50,000 taxable capital gain, because the capital gains inclusion rate is still technically 50%. We'll see what happens with the proposal at 66, but right now we're still at 50. So that capital gains inclusion rate means that the other 50% is tax-free. That is a CDA credit. So again, we don't want to get too technical here today, but that CDA credit, capital dividend account credit, allows you to pull that $50,000 out of your corporation completely tax-free. Very valuable tool. Another one would be a life insurance strategy. Another one would be to invest in your business. Another one would be to sell shares of the business in the future, or just to pay dividends. So we would kind of balance these things based on your current situation and your goals, and make sure that those things are aligned with what you're ultimately trying to accomplish, your tax situation, how do you keep more money in your pocket, and how do you make sure that you get to ultimately where you want to go by building a properly structured financial plan. Vinyara, I hope I pronounced that right. The fee paid to you, can it be part of my corporate expenses? Yes, absolutely. Our fees are 100% tax deductible to your corporation, which is an incredibly important piece. The the more tax benefits we can build and establish and focus on, yes, you can draw funds from your corporation. I'm sorry, not draw them from. You can pay them from your corporation when working with us, and it is fully tax deductible. Bob, connected with my previous question, structuring of paying out dividends versus salary from Canadian company when you have foreign income. Yeah, Bob, I think that there wouldn't be any issues here unless that foreign income would be, if you're paying that foreign income out, it's different. But I don't think that I don't think I'm totally understanding the question. I'm really, really sorry. Um, Structuring of paying out dividends versus salary from Canadian company when you have foreign income. I mean, I will just note there's lots of nuances. So, we do have situations that come up where we would recommend salary. So if there's different nuances that affect that, and different reasons why we wouldn't want to pay dividends, we could potentially look at that. The presentation today was much more on your generic kind of structure as a business owner and an entrepreneur, and having that flexibility and access to that money as opposed to, a Canada pension plan, which you may not actually end up getting. But I'm not sure, we'd have to integrate this in. Foreign dividends are coming into your corp. Is this an investment? Is this another corporation? We'd have to dive a little further to unpack that properly. Ryan, good mortgage broker. That's great. Thank you, S. Bradshaw. Glad you got some value. Thank you, everybody. Victoria, you mentioned that business owners should pay themselves through dividends. Is there a situation where a combination of salary and dividends would be beneficial? Victoria, yeah, possibly. Again, every situation is unique. You never want to make an absolute, never pay yourself salary. There are some situations that sometimes come up. For this particular situation, we don't like utilizing the Canada Pension Plan and tying up all this money with the concern that maybe you will never get it. So I think it's important to note that nothing is ever absolute, although it is very rare that we find a situation where salary makes more sense. But it does happen. And Victoria, for you, we would dive into that and look at, what is the optimal scenario. If you're paying a portion of salary and a portion of dividends, you would be paying into the Canada Pension Plan with that salary base. But I'll use one example. So previously, medical doctors in British Columbia got a supplement paid into a retirement fund from their BC Medical Association. They had to pay themselves a salary to get that. That has changed now because they recognize so many of these doctors wanted to be paid dividends. So now they still get that BC Medical Association chunk of cash, even if they pay themselves a dividend. But before then, we always recommended salary because it's free money. They're going to pay into your RSP for you. It's an additional surplus of cash. So it made a lot of sense to pay yourself a salary to get that BC Medical Association surplus contribution. Matt K, meeting scheduled to end in 5 minutes. I'll stay until you're finished and share a recording with notes for follow-ups. With the property transfer tax in BC, if you sell a corp that owns real estate, is the property transfer tax avoided on the real estate as the owner of the real estate is still the corp? Graham, yes, you are correct. Owning investment property in a corporation and selling that corporation is a good way to do it to avoid property transfer tax. I will just note that sometimes you got to be careful with it because sometimes people are hesitant to buy the corporation in case that corporation has, outside debts or some challenges or anything that comes up. So, but yes, absolutely, that is a tool that we use all the time for investment property, commercial real estate, things like that to avoid that property transfer tax at sale and keep more money in your pocket. Matthew, what is our fee? So our fee is a flat fee and it's based on complexity. So our fees are anywhere from $6,500 for the most basic financial plan per year, all the way up to 15 is usually the higher end. Sometimes we've gone as high as 20, which is rare. Most people in this presentation will very likely be somewhere between 6,500 and about 12,000, depending on the complexity of your situation and making sure that we can add the value on every aspect of what you're trying to accomplish. Dina, if I already pay salary to myself, is it okay to switch to paying dividends only? Yep, Dina, absolutely. And I would make sure you integrate that properly and you stay on top of it. One of the reasons why we do this in January is because it's a good time to make that switch for this year. But yes, absolutely, you can switch it. Victoria, you mentioned that business owners should pay themselves through dividends. Is there a situation where I already got to that one, I think. Victoria, yes, you're very welcome.